I've honored my promise to my dad, and I buy something every 2 weeks. I have for 33 years. I have never, not once, missed a 2 week period ever where I didn't accumulate some gold or silver when we got paid. And to me, I have always looked at it as wealth. It's not an investment to me. And it's wealth that has outlived 2 world wars, German hyperinflation, the Great Depression, every pandemic, anything the world has ever thrown at it, frankly, which leads us to today, where over the last 18 months, the central banks, the most well-funded and well-informed traders on the planet, have bought more than they ever have in history. And so they find it to be significant. But what opened up my eyes is an event that happened in 2019. And it really started opening my eyes in 2017. In all of the public speaking I was doing, I would talk about what started to happen in 2017. In 2017, we had witnessed 6 years of a downdrafting market where the price of gold and silver, from its high of $1,915 in gold and just about $50 in silver in 2011, from that point forward for the next 6 years, it drafted downwards. And by 2017, I wanted to hide under my desk or just not come into the office, because for the first time in my career, everyone was selling. What was typically 1 out of 100 transactions was now 65% of everyone's business in this industry were people selling, aggravated that gold didn't live up to its reputation as a cut from the same cloth as Bitcoin soared to the heavens, and the stock market, having no gravitational pull, continued to move higher, and people capitulated.
Andy Schectman often highlights what happened around 2017 as a pivotal moment for gold. He points out that, amid widespread anti-gold sentiment, the German Bundesbank made a very public demand for the Federal Reserve to return its gold after 3 years of trying. This move caught his attention. Why was the Bundesbank repatriating their gold when central banks had been selling gold for years? What really stood out to Schectman was that, just months after this, several other major central banks followed suit. The Bank of Austria, Poland, Hungary, the Czech National Bank, and the Dutch National Bank all demanded the return of their gold from the New York Fed and the Bank of England, making their actions quite public. By 2018, these same banks had collectively purchased more gold than they had in the prior 60 years combined. Schectman often says this massive wave of acquisition and repatriation by some of the most informed institutions on the planet wasn't random. Then in 2019, they doubled their gold purchases, and the Bank of International Settlements, the central bank of central banks, reclassified gold as a Tier 1 reserve asset, equal to US dollars and treasuries. Schectman emphasizes how significant this was. Gold had always been treated as a Tier 3 asset, meaning only 50% of its value was recognized on balance sheets. It was costly to store, earned no interest, and was often sold off for assets that performed better. But now, central banks were treating it differently, buying it aggressively and repatriating it.
That last year, or the last 15 months, they've bought more than at any time in history. This, to me, is the underlining why, is that gold is wealth, gold is money, and gold is viewed that way by the most influential players on the planet. They use the Western suppression of COMEX in order to run cover for their acquisition. If I want to buy a COMEX contract, which was 100 ounces, to hedge my position in my warehouse, I only need $7,000 or thereabouts in my margin account, and I control nearly 200,000 worth of gold. If I am a commercial bank or a central bank with 500 million in my margin account, I control 15 billion worth of gold on COMEX. I can create any perception of reality I want. And that is exactly what has happened for a very long time. There's a term in economics called Gibson's paradox, which speaks to the inverse relationship between real interest rates, which have been horrible, and the price of gold. And if you are going to maintain super low manipulated interest rates to create a perception or an illusion of prosperity that we did for so long, then you have to step on the canary in the mine shaft, and that was the price of gold. And yet all of a sudden, the most influential, well-funded banks on the planet are not only buying it at levels we had never seen before, but they were repatriating it from the exchanges and the Western central banks. So to me, on a very, very,
He
very
highlights the
basic
immense
level.
scale of the U.S.
That's why
Treasury
people need to
market,
own it,
which
because
handles
the most
approximately
influential, well-funded,
$900 billion
well-informed
in
traders on the globe
transactions
say
daily,
one thing and
with
are doing the
high-volume
other and
days reaching up
accumulating it
to
as if it is
$1.5
really
trillion.
important. So on a
The
very
repo
generic,
market,
basic
a
level, the
crucial
biggest money in the
mechanism
world
for
says you
financing,
should own it by
processes
their
around $4
actions,
trillion
less by their
each
words,
day.
and they're using
Farber points to
manipulated
U.S.
price to run
Treasury
the cover
futures,
for their
which saw an average
de-dollarization
daily
and their
trading volume of
acquisition.
about
That's why you need to own it. Look, the
$750
paper
billion
market
in
still is the tail
2024,
wagging the
as a
dog, no
focal
question
point where
about it.
pressures
But
are
I could
mounting.
argue it's losing its
Recently,
ability
traders
to
have leaned
continue to do
heavily
this
into
at a
basis
rapid pace.
swaps
The London
involving
Metals
secured
Exchange is a good
and
example.
unsecured
They have
overnight
pretty
U.S.
darn
dollar
close to the
rates
lowest
as
amount of
funding
silver
pressures
in the
ripple through
exchange
repo markets.
that they've had in the
Farber suggests that
140-year
based on
history of the
historical
exchange.
patterns,
We've seen
the
a
Fed's
massive
response
bleed
this
down in
time could
gold
be
and
even
silver
more
off the
aggressive than during the
COMEX market,
2020
where
crisis,
in
with faster
2020,
money
this
printing.
group
He also
they're
warns that
called
the
the
repo to
others on the
reserve ratio
COMEX.
is
They
near
came out of
levels
nowhere in
reminiscent of the
2020. There used to only be 2
2019
groups of
crisis,
reportables
which
on
could
what they call the
significantly
Commitment of
weaken the
Traders
U.S.
report.
dollar.
Every week, the
Farber
exchange
believes this
publishes the
escalating
positioning of the
leverage is
largest
creating
traders,
a
and it was
cycle
always just the
reminiscent of a
commercial
Ponzi
banks
scheme.
and the
He explains
specs,
that
which would be the
firms
hedge
depend on the
funds.
repo
That's
market to
it.
fund
And then
leverage
out of
trades,
nowhere in
but are
2020, they published
increasingly
a
stuck in
new
positions
group of
that require
reportables they
more
call the
borrowed
others.
dollars
I
to
believe they are
sustain.
sovereign
When the
wealth
supply
funds
of new
and
dollars
very
dries up,
well-to-do family
the repo
offices
market
who
could
are
freeze,
draining the exchanges
compelling the
along with the
Fed to
central
intervene.
banks, to the point
In such
where
a
in 1
scenario,
year in
Farber
2020, we
expects
saw more
gold to
silver
rally as
delivered than in a
investors flock
decade
to it as a
before
safe haven.
combined. They
As
took
for
more gold
Bitcoin,
off in
he
2020
remains uncertain
than the
about its
Bank of
role during the
Japan has in their
crisis,
official holdings. And
emphasizing
these
that gold's
trends,
historical
both in what's
reliability
called
is likely
exchange
to
for
prevail.
physical, where you can buy a COMEX contract and exchange it for physical in London.
Andy Schectman often points out the remarkable events of 2020, noting that more gold was taken off the market that year than the Bank of Japan holds in their official reserves. He explains that this trend, alongside mechanisms like exchange for physical, where COMEX contracts can be converted into physical gold in London, and the bleeding of metal from the COMEX, has brought the market to unprecedented lows. The registered category of silver, for example, hit its second lowest level in COMEX history, with gold reserves also seeing significant depletion in a system that was never really designed to handle such large-scale deliveries. Schectman emphasizes that this dynamic is making it increasingly difficult to suppress precious metal prices. When prices are artificially pushed down, sovereign nations and wealth funds are quick to step in, saying, "We'll take delivery." This growing trend of physical delivery is reshaping the market, especially as the available metal on these exchanges continues to diminish. According to Schectman, this tightening supply is bringing the market closer to a critical inflection point. While manipulation was once easy when demand for gold and silver was low, the current environment makes such strategies increasingly risky, a dangerous game. For those attempting to suppress prices,